Hi guys, and welcome to today's vlog. Today you're going to see one of my really great friends. His name is Jeff Badu, and we actually went to the University of Illinois in Champaign together in undergrad, and we were both in the College of Business. Jeff has gone and studied in accountancy and has gotten his CPA license, and so now he has left the Big Four accounting and started his own company called Badu Tax Services. So I was invited to hear him speak at his church, and he dropped some major gems about taxes and 401ks and when you leave a company, what to do. So for anybody that has left your company, especially those that have left their company and have gone into self-employment, so they're not going to another company anytime soon, you definitely want to tune in. I learned so much from this, stuff that I even used. So after I heard him speak, I set up an appointment because I needed to deal with my 401k. So stay tuned. You guys will not want to miss this. And here we go. Mr. Jeff Badu.
Yeah, so as far as credentials, I graduated from the University of Illinois with a bachelor's and a master's degree in accounting. I'm also a licensed certified public accountant. I'm a financial coach. I'm life and health licensed, so if you need life insurance or health insurance, I can actually provide that for you. I do small business coaching. I do some QuickBooks trainings and things like that. And so just a little bit, so I have a tax firm, I do financial coaching, I do some credit repair, so if you need any credit related things. I help appeal property taxes for people. And then I also teach. I teach across the nation. I'm actually going to a medical conference next Saturday to give similar to what I did today. And then also I do, I own a real estate company, I own a car rental company, and that's pretty much it. Yeah, so I'm also the treasurer of the National Association of Black Accountants, as well as the Ghana National Council.
Okay. Well, the reason is to know that we have an asset within us. Let's make use of it. In addition to him, there's.
I would say it's best to be a long-term investor because money compounds over time. I mean, I started investing back in 2013, and I put a decent amount into General Electric. And then three years later, it actually doubled. And so that's just one example.
So what about bonds?
Yeah, so bonds are good. There's different types of bonds. You have investment grade bonds and you have junk bonds. So I would say with bonds, you definitely want to be on the investment grade side, on the safe side. But at the same time with bonds, they don't provide as much return as the stock market or as these other investments. So bonds are good. They're safe. Especially if they're government bonds. So they're pretty good. You just have to be willing to suffer the lower return. And you should at a minimum be earning at least inflation or hopefully better than inflation.
I have 3 beautiful kids, and I try to save for, on the stock market, but then basically I lost almost everything. What exactly can you say for the mothers to invest for the kids, because you will not get it like 1,000 every day to invest for them. You have to invest gradually to get this. So what would you recommend for parents like me?
Yeah, so the first, I would say when it comes to the kids, my favorite type of plan is, so for the first, to answer your first question, and losing all the money. So it really depends on the type of stock you invest in. So as I was saying before, if you invest in a company like Apple or Microsoft, General Electric, these companies that have been there for a long time, if you look at a 5-year chart, you'll notice that it's been going up basically. So I believe it depends on the type of stock you're investing in. So if you're investing for the long term, do it in a company that's safe, or they have even index funds nowadays that you can put in. And the money can grow over time. It can pay dividends. So for the kids, I would say do it on a more pick some safe investments. And the one type of account that I really recommend for basically anyone that's saving for education, it's It's basically an account where you can contribute up to like $14,000 a year per child, and you get a lot of different tax write-offs. So the state can actually match you sometimes your contributions and different things like that. For some reason, the name is like blanking from me, so I can talk more about that later. But ultimately, you want to put it into something that's pretty safe.
Is it a universal life plan?
So you could use. I'm glad you brought that up. You can actually use life insurance to fund your child's education. And you can actually have upside. I was saying with the 13%, there's a universal life insurance policy that pays you up to 13% if the market is doing well. And if the market is doing really bad, if the market is doing like negative 13% or negative 30%, you actually gain 1%. So they limit your upside, but they also limit your downside. But you're much better on the upside side.
Hey, question. Is it called like for children, is it called like a 529?
Yeah, I'm sorry. That's exactly it. It's the 529 plan. For some reason, that was blanking for me, but that is my #1 recommendation for if you're saving for college, because you get the tax write-offs and different things like that. And it's the #1 rated investment vehicle for Americans that are saving for their kids nowadays.
Any more questions? Quick one.
So you said the Roth IRA is better than the other. Let's say I'm not switching jobs. Let's say I'm at the same job place, right? Is it better to switch the 401k, let them deduct the taxes, and you switch it to Roth IRA, or it's better to wait till you move into a different job?
Yeah, I would say with the 401k, I would make all the contributions towards the Roth. So you have traditional IRA, Roth IRA, and then you have traditional 401k and Roth 401k. So I would say if you're at the same job, I would switch. If you have traditional 401k now, pre-tax, I would do it into the Roth 401k after tax, because of the tax-free earnings that you can get. And then whenever you leave a job, this is very important, you always want to roll over the money that's in a 401k, because 401ks are known for having very high fees. And once you leave, those fees really get activated. So as soon as you leave, the first thing you want to do is roll over the money to either an IRA or into your jobs, your new jobs plan, because then they can suck up some of those fees.
We good? Okay. Oh.
I was going to say the same thing. I have 401k with a different company, but then since I lost my job, I've not done anything to it. What do you suggest I do, basically?
I would say the first thing you should do is tomorrow morning, you should call them and please roll it over, because I know somebody who had a job, they left it, and they left their 401k, and it got depleted by like 50% just from fees alone. Because once you leave, they don't take over those fees for you. So when you're at the job, they supplement your fees. They pay a certain amount because they're the plan administrator. But as soon as you leave, they say, okay, well, we're not going to pay your fees because you're not an employee anymore. So the best thing to do, and I would do this probably as soon as tomorrow morning, is to call your old job and ask them to roll over your money into your new jobs plan or into an IRA plan.
Any more?
Thank you all.
Jeff, as you know, thank you so much. Can we give a hand of applause to Jeff? Thank you. You know the